All right, let's get right into it. We're going to break down Delta's latest financial report. But trust me, this is not just about a bunch of numbers. What we're looking at here is a fundamental, historic shift in how an airline actually makes its money. It's a story that really changes the way you should think about the whole business of flying.
So let me just start by throwing a question out there. It might sound a little bit out there, but it is at the very heart of everything we're talking about today. What if the main cabin, the part of the plane where most of us actually sit, what if that just wasn't the main business anymore?
Because, well, that's not a hypothetical question anymore. According to Delta's brand new numbers, we've just officially crossed a massive tipping point. The moment where that question became a reality, it just happened.
I mean, just look at these numbers. They tell an absolutely incredible story. For the first time ever in its history, in the last quarter of 2025, Delta made more money from its premium seats, we're talking first class, Delta One, the works, than from the entire main cabin. And look at the trend. Premium revenue jumped up 9%, while main cabin revenue actually dropped by 7%. This isn't just a small tweak, it's an earthquake for the industry. So, you gotta ask, what's going on here? Why is this happening now? Well, a huge piece of the puzzle is this thing economists are calling the K-shaped economy. And it's pretty simple, really. Imagine the letter K. The top arm is going up. That's the more affluent folks spending more and more on premium experiences. The bottom leg, though, is going down. That's more budget-conscious people pulling back. And Delta, they are betting everything on that top arm of the K.
Okay, so how exactly did they pull this off? Believe me, this was not an accident. It's a very deliberate, multi-billion-dollar strategy. Let's open up their playbook and see exactly what they've been up to.
See, they didn't just jack up the prices and call it a day. No way. They poured money into making it feel worth it. We're talking about incredible, exclusive Delta One lounges like a JFK and LAX, where you get full-on restaurant service. They've created all these different seating tiers to give you more reasons to upgrade. And it's the smaller stuff too. Better service and rolling out free, fast Wi-Fi. The point is, you're not just buying a seat anymore. You're buying a whole premium experience.
And it is clearly working. The demand is absolutely there. The CEO, Ed Bastian, has come right out and said it. 2026 is already off to a flying start. And it's not just corporate travel, it's high-end leisure customers too. They are convinced this isn't some passing fad. This is the new normal.
But here's the thing. Selling those fancy seats, that's only half the story. The other half, the real powerhouse humming away behind the scenes, has way less to do with actually flying and a lot more to do with what's in your wallet. And that's the loyalty engine.
Just get a load of this number. $8.2 billion. That is how much money Delta's partnership with American Express brought in during 2025 alone. Let that sink in for a second. That's not from selling tickets. That's from their co-branded credit card. It is an absolute cash machine.
So when you put all that together, the loyalty income plus the premium seat revenue, you end up right here, 60%. A full 60% of Delta's business is now coming from something other than a standard economy ticket. The takeaway here is huge. Delta has basically insulated itself from the brutal, razor-thin price wars of selling cheap seats. It's a whole new ballgame. And if you want something to really help you wrap your head around the scale here, try this on for size. The total amount of money people spend on those Delta Amex cards is getting close to 1% of the entire gross domestic product of the United States. Yep, 1% of the whole U.S. economy. That's not just an airline loyalty program, that's a financial behemoth.
Okay, so this strategy is obviously making a ton of money. But what does that actually mean for the company's financial health? Well, it means they've been able to build what they call a fortress balance sheet.
In 2025, this whole strategy generated a record $4.6 billion in free cash flow. That's just pure cash left over after all the bills are paid. And what did they do with it? They turned around and paid down $2.6 billion of their debt, which makes the whole company way more stable and resilient.
This number right here, 2.4x, that's their gross leverage ratio. Now, you don't need to be a Wall Street analyst. All you need to know is that for this number, lower is better. And 2.4x is a really, really good number. It's a signal that Delta's finances are in fantastic shape.
And here it is, the ultimate seal of approval. Delta has now earned an investment-grade rating from Moody's, S&P, and Fitch. Getting that stamp of approval from all three big agencies is a massive vote of confidence. It's the financial world giving you a gold star, telling the market this business model is built to last.
So you've got a winning strategy, you're flush with cash, your books are clean. So, where do you go from here?
Let's take a peek at how Delta plans to fly into the future.
Well, they are definitely not slowing down. Their forecast for 2026 is incredibly optimistic. They're projecting around 20% growth in earnings and another massive year of free cash flow, somewhere between $3 and $4 billion. Their leadership is clearly confident that this premium strategy has a lot more room to run.
And they are putting their money where their mouth is. They've placed this huge order for new Boeing 787 Dreamliners, but here's the detail that connects everything back together. These new planes are specifically designed with a premium heavy cabin. That means more real estate for the front of the plane and less for the back. They are literally building their future fleet around this new, premium-focused reality.
Which, of course, leaves us with one final and pretty big question. As this K-shaped world continues to split travel between luxury and budget, are we heading for a future where all the innovation, all the investment, all the focus from major airlines is only on the front of the plane? It's a huge question about what the future of flying is going to look like for everyone.
Okay, imagine this for a second. Your company just had its absolute best sales year in its entire history. You brought in more cash than ever before. But then, when you look at the bottom line, the profit has basically vanished. Well, that's the bizarre puzzle that American Airlines is facing right now, and it's a story that has the whole industry scratching their heads. So, seriously, how does that even happen? How can you be soaring higher than ever on one number while completely nosediving on another? It's a real financial mystery, and the answer tells you a lot about the incredible pressures on one of the biggest airlines in the world as it flies right into its 100th anniversary.
All right, to crack this case, we've got to start by looking at the two numbers at the heart of the whole thing. They sit right next to each other on the financial reports, but they tell two completely opposite stories about the airline's health.
First up, the really, really good news. American Airlines pulled in a record-shattering $54.6 billion in revenue for the full year. That's the most money the airline has ever made in its history. Period. On the surface, that looks like a home run.
But here's the twist, and it is a shocker. Out of that nearly $55 billion, you know how much they actually kept as profit? Just $111 million. It is a tiny, tiny fraction of their sales, and it's a massive collapse from the year before. So, where did all that money go? And right here, this is where the paradox just smacks you in the face. Revenue, like we said, hit a record. It ticked up by just under 1%. But the profit? It just fell off a cliff, dropping by a jaw-dropping 86.8%. It's like you're in a car, slamming on the gas and the brake at the exact same time.
You see a drop like that, almost 87%, and you have to ask, what on earth could be powerful enough to squeeze billions of dollars out of a record-breaking year? Well, it turns out American was fighting a war on two different fronts.
Yeah, it was this brutal 1-2 punch that just hammered their bottom line. On one side, you had this huge external shock they couldn't control at all, the U.S. government shutdown. And on the other, you had this intense internal pressure from the skyrocketing cost of just keeping the airline running every single day. Just take a look at the cost side of things. In the last 3 months of the year alone, salaries and benefits shot up almost 10%. Selling expenses, that's stuff like marketing and travel agent commissions, they surged over 10%. Even the price of jet fuel jumped 8%. All of a sudden, every single piece of the operation got way more expensive.
And then there was the shutdown. American figures it lost a stunning $325 million in revenue just in the fourth quarter because of it. To put that into perspective for you, that one single event wiped out almost 3 times what the airline ended up making in profit for the entire year.
And this hurt American more than anyone else because of their specific network. See, they're the most exposed to U.S. domestic travel, and their big hub at Reagan National in D.C. relies heavily on government employees and contractors, travel that just completely ground to a halt.
So, you're facing this perfect storm of rising costs and revenue getting hammered. What's the comeback plan? Well, American isn't just sitting there and taking it. They have a really clear strategy to fight back. And it's all about going all in on their most valuable customers.
So how do you stay optimistic in a spot like this? Well, the airline's CEO, Robert Isom, is basically betting the farm on this multi-year plan. He believes it's not just going to help them recover, but it's going to set them up for real long-term success.
And their game plan is actually pretty straightforward. It's built on 3 big pillars. First, go after premium revenue like crazy. Sell more of those expensive seats up front. Second, make their A-Advantage loyalty program so good that people won't even consider flying another airline. And third, win back all those big money corporate travel accounts they'd lost.
And hey, the early signs are actually pretty good. This isn't just some idea on a PowerPoint slide, it's already getting results. Their premium revenue is growing 7 points faster than the main cabin. Corporate revenue is on the rise, and their loyalty program is signing up a record number of new members who are spending more money. It seems to be working.
But, a great offense needs a great defense. And for an airline, that defense is a rock-solid financial foundation. So, while American is out there chasing all this new revenue, they're also fighting another huge battle on the other side of the books, their debt.
And they've made some really impressive headway here. Even while they were dealing with all those crazy cost pressures we just talked about, they still managed to pay down over $2 billion in debt in 2025 alone. That's no small feat.
That progress is huge because it now puts them on track to hit their next major debt reduction goal a full year ahead of schedule. And let me tell you, for Wall Street, that is a massive vote of confidence in their financial discipline. The ultimate goal here is super ambitious. They basically want to turn back the clock and get their net debt down to a level they haven't seen in over a decade. If they can pull that off, it gives them way more flexibility and makes them a lot tougher for the next time a crisis hits.
So all of this, the focus on premium travelers, chipping away at the debt, it's all building towards one massive year, 2026, the airline's 100th anniversary. It's a huge milestone, and the company is making a gigantic bet that this is the year their whole strategy finally clicks and really takes off.
And their forecast is incredibly bold. They're predicting a huge jump in earnings per share. That's the profit for each share of stock. And they're expecting to generate over $2 billion in free cash flow. That's pure cash left over after all the bills are paid. All while bringing in 55 brand new planes and adding premium seats twice as fast as they're adding seats in the back.
But despite all this optimism, we have to face one crucial reality check. In 2025, if you took all the profits made by American, Delta, and United and put them in one big pile, American's slice of that pie was less than 4 cents on the dollar. The gap between them and their rivals is still enormous.
Which leaves us with the big, final question. The strategy is clear, the investments are being made, the goals are set. But as American Airlines heads into its 100th year, will this high-stakes gamble on the premium traveler finally be enough to close that profit gap and let them truly compete with their biggest rivals? I guess 2026 is the year we're all going to find out.
For like decades, Southwest Airlines built its entire brand on being different, right? No bag fees, no assigned seats, just simple, cheap flights. Well, a recent earnings report suggests a massive change is coming. The Southwest we all know and, well, love might be gone for good. So what is really going on here? And I mean, the change is pretty stark. We're going from the classic Southwest, bags fly free, that kind of chaotic, but kind of fun, open seating, to a whole new world. Think checked bag fees, think assigned seats, and yep, even basic economy fares. This is not just some minor tweak, folks. This is a total rewrite of their core identity. So how in the world are they pulling this off? Well, let's take a look at their transformation blueprint. This is their plan to completely tear down and rebuild their business model, all in the name of making more money. Okay, this is their new playbook, and it's basically a list of things that used to be totally forbidden for the brand. First up, checked bag fees are coming. They're also launching basic economy fares to go head-to-head with the budget guys. And get this, they're rolling out assigned seats and even extra legroom options. On top of all that, they're shaking up their rewards program and expanding online to get more business travelers on board. Every single one of these is meant to be a brand new fire hose of cash. But, the big question is it working? Well, the first signs are in, and they come from their record-breaking fourth quarter of 2025. These numbers are our first real clue that, yeah, this new strategy might actually be paying off big time. The top-line number is just wow. Southwest brought in $7.4 billion in operating revenue in just one quarter. That's not just good. That is a new all-time record for the company. And it's not just about making money, it's about keeping it. They turned all that revenue into $323 million of pure profit. So the really important thing here is they're not just growing, they're becoming much, much more profitable. It's a clear sign that things are turning around. And just to put that in perspective, let's look at it year over year. From the end of 2024 to the end of 2025, revenue jumped 7.4%. That's not just a little bump, that is significant growth. And you can draw a straight line from that growth right back to these new strategies. But believe it or not, those huge results are just the beginning. They set the stage for what we're calling the $4 bet, which is management's wildly ambitious goal for the next year. And I'm not exaggerating here. This next goal is so bold, it's made everyone on Wall Street do a double take. It's a forecast that just screams confidence in their new plan. Okay, just look at this jump. In 2025, Southwest's adjusted earnings per share, or EPS, was 93 cents. For 2026, management is saying they're going to hit at least $4. That's more than a 300% increase. It is an absolutely massive bet that this new model is going to be a home run. And this isn't just us reading between the lines. Southwest management put it out there themselves, saying this forecast signals their strong confidence in the airline's transformation program. They are going all in on this new direction, no question about it. So, what does all this mean for you, for me, for the actual people flying on these planes? Well, this really gets to the heart of the matter, doesn't it? It's this tricky balancing act between raking in profits and holding on to the brand loyalty that Southwest spent 50 years building. And it is a high-stakes gamble. I mean, the opportunities are obvious. Way more revenue from every passenger, much stronger profits. But the risks, they're just as big. Are loyal customers really going to stick around with all these new fees? Can Southwest still stand out when it starts acting like every other airline? And that's not even counting the stuff they can't control, like a shaky economy or another spike in fuel prices. Which brings us to the final, burning question. You know, Southwest stock ticker is LUV, a nod to its whole customer-first vibe. But now, as it chases these huge profits and a $4 EPS, the big challenge is this. Can Southwest get richer without losing its LUV?
Today, we're diving into how one of the world's biggest airlines navigated the ridiculously tough aviation industry to have, well, not just a good quarter, but the single best quarter in its nearly 100-year history. So let's break down how United Airlines managed to pull this off.
Okay, let's just start with the headline number, the one that makes you do a double take. $15.4 billion. That's how much revenue United pulled in during the fourth quarter of 2025. And just to be clear, that's not just a record for Q4, that is the most money they have ever made in any single quarter in the company's entire history. A truly staggering figure.
And yeah, that brings us right to the big question, doesn't it? The airline business is just brutal. You're dealing with everything from crazy fuel costs to cutthroat competition. So how on earth did United not just get by, but put up these kinds of record-breaking numbers? That's exactly what we're about to figure out.
So first up, let's talk profits, because this wasn't just about massive revenue. United's profitability, what Wall Street really cares about, actually beat analyst expectations by a solid 5.4%. That tells you there's some real strategic muscle behind these numbers.
So what's the secret sauce? Well, this wasn't an accident. It wasn't luck. It's the result of a very deliberate strategy, something they call the premium playbook. It's all about a major pivot towards a very specific and very profitable kind of customer.
Now, check this out. This chart right here really tells the story. Look, their overall revenue grew by a pretty healthy 4.8%. Not bad at all. But then, look at the revenue from their premium cabins. We're talking first class, business class. That shot up by 9%. The premium part of their business isn't just growing, it's growing at nearly double the speed of everything else.
You can think of United's whole profit strategy as this powerful two-engine growth machine. These two things are working together, pushing the airline forward, their premium seats and, maybe surprisingly, their loyalty program.
And here are those two engines just firing on all cylinders. On the left, you've got that 9% growth from selling those fancy seats up front. But on the right, look at that, a massive 10% growth in loyalty revenue. Their Mileage Plus program has turned into this incredible moneymaker, pulling in cash from things like co-branded credit cards. It's super high margin money, and they don't even have to fly a plane to earn it.
And hey, don't just take my word for it. You can hear it straight from the top. The CEO, Scott Kirby, said it himself. This is all about winning brand-loyal customers. It's a huge shift, right? It's not just about selling a cheap seat anymore. It's about building a real, high-value relationship that keeps people coming back.
But you know, a brilliant strategy is just words on a page if you can't actually pull it off. So let's look under the hood at the unseen engine driving all this success. Just plain old operational excellence. Because for those high-paying premium travelers, getting the basics right is everything.
I mean, just try to wrap your head around the scale here. In 2025, United flew a record 181 million passengers. That's like moving nearly 500,000 people through the skies every single day. Trying to manage that while also getting better is a huge, huge challenge.
And they absolutely nailed it. This is the key part. While flying more people than ever before, United also had its lowest seat cancellation rate in its entire history. For a premium customer who paid top dollar, reliability isn't some nice bonus. It's the bare minimum, and this metric shows they are absolutely delivering.
And they're getting smarter too. Take this cool piece of tech they have called Connection Saver. It basically uses data to hold a connecting flight for just a few minutes if your incoming flight is a bit late. Last year alone, it saved over 1 million connections. That's 1 million people who didn't have to do that mad dash to the airport. A massive win for keeping customers happy.
Now, of course, every grid strategy gets tested, and in late 2025, United's whole playbook faced this massive, completely unexpected test, a U.S. federal government shutdown that basically threw the entire aviation system into total chaos. So, for 43 long days, the shutdown just created a nightmare. Air traffic controllers were impacted, so the FAA had to step in and force airlines to cancel flights. We're talking over 10,000 cancellations across the whole industry. It was a huge operational and financial storm. And this slide right here says it all. The shutdown cost United about $250 million, a massive, massive hit. And yet, on the other side of the equation, they still delivered record revenue and beat earnings. This just proves how tough and resilient their business model has actually become. So they've proven the model works even under extreme pressure. So what's next? Well, they're not taking their foot off the gas. They are doubling down. Let's take a look at their flight plan for 2026.
I mean, their outlook for 2026 is incredibly confident. They're projecting serious earnings growth, and they're putting their money where their mouth is, with huge investments, over 100 new jets for their domestic routes, and 20 brand new Boeing 787 Dreamliners, specifically to grow that premium international service to places like Europe and Asia. You know, this success isn't happening in a vacuum. It actually highlights this huge gap that's opening up in the airline industry. On one side, you have carriers like United and Delta who are making almost all the profit by investing in a better experience. And on the other side, you've got the budget carriers who are struggling, facing bankruptcies. It's really a tale of two completely different flight paths.
And that really brings us to our final big question. As these airlines focused on the premium experience just keep pulling away, are we seeing a fundamental change in how we fly? Is the old model, the one that was all about finding the absolute lowest price, no matter what, is that model reaching its limit? It's a question that could really redefine air travel for all of us in the years to come.
Today, we're diving into a really interesting story, all hidden inside an earnings report from Alaska Air Group. We're going to look at how an airline's profit can get sliced in half, but somehow Wall Street is still cheering them on. It's a fascinating tale of big ambitions, bold strategy, and some truly eye-watering numbers.
Okay, let's get right into it because this is the central paradox that has everyone talking. You know, it's one of those classic situations where the headline number, it doesn't even come close to telling the full story.
So check this out. On one hand, you look at the full year and their adjusted profit got basically chopped in half. It dropped from almost $5 a share down to $2.44. Ouch. But then you look at just the final quarter of that same year and it wasn't just good, it was a blowout success.
Profits soared 290% higher than what Wall Street was expecting. So what on earth is going on here? Well, the answer lies in one of the biggest, boldest moves in the airline's entire history. It's a move that comes with a very specific and very, very large price tag.
Here's the heart of it all. Alaska Airlines went out and bought Hawaiian Airlines for $1.9 billion. And as you can probably imagine, merging two gigantic airlines, well, it's not like clicking two Lego bricks together. It is an incredibly complex and, believe me, incredibly expensive thing to do.
And just to put a number on it, in that final quarter of 2025 alone, the company spent $250 million on what they call integration costs. These are massive, one-time expenses, right? We're talking about combining all the tech systems, figuring out how to merge two different fleets of airplanes, and retraining thousands of employees. That's the stuff that dragged that annual profit number down.
And this quote from their own CFO really says it all. They knew 2025 was going to look a little rough on paper. They basically see this short-term financial pain not as a problem, but as a totally necessary investment for a much, much bigger plan down the road.
So let's move on and see how this massive, expensive bet is already starting to show some really promising signs that it's going to pay off, even while all of that integration work is still happening.
Now, what's really interesting here is just how fast they're moving. Look at that timeline. They got what's called a single operating certificate in just 13 months. Now, if you're not in the aviation world, that's the official government green light to operate as one single airline. And getting it that fast, that is an industry record. It's a huge sign that they are executing this whole thing incredibly well.
And look at this. At the same time they're spending all this money on the merger, the core business is just showing remarkable strength. For the first time in years, the Hawaiian brand actually made a profit. Corporate travel is bouncing back, more people are buying those premium seats, and hey, even cargo revenue shot up an unexpected 22%. These are all signs that the engines are running really strong.
Okay, so this all brings us to the master plan. This is the strategy that justifies all that short-term cost and all that complexity. It's a 3-year plan they very fittingly called Alaska Accelerate.
And the goal here is incredibly ambitious. They're looking to generate an extra $1 billion in profit by the year 2027. That is the prize they have their eyes on, and that's exactly why investors are willing to look past that temporary dip in the annual profit. Now, this isn't just some hopeful number they pulled out of thin air. Nope, they have a really detailed breakdown of exactly how they plan to get there. As you can see, the biggest piece of the pie comes from cost and network synergies. You know, the direct financial benefits of bringing the two airlines together. But they also have big plans to grow their loyalty program and expand their international routes and premium offerings. And what all this means is that you, as a passenger, are actually going to see these changes. You'll start to see more first and premium class seats on the planes, you'll see new international destinations pop up from their Seattle hub, and you'll probably be flying on brand new, more efficient aircraft.
So with this massive transformation underway, what does the immediate future look like? I mean, is it all clear skies ahead from here?
Well, not exactly. Despite all of internal optimism and their really strong execution, the airline is being very realistic. They've put out some pretty cautious guidance for the next year, basically acknowledging that things like the global economy and, crazy fuel prices are totally out of their control. This wide forecast shows you exactly how they're planning for that uncertainty. You can almost think of it as a best case, worst case outlook. The low end kind of accounts for a potential economic slowdown, while that high end, that reflects what could happen if the economy stays strong and business travel just keeps on booming. So ultimately, this whole story is about a huge, calculated gamble. Alaska Airlines is choosing to fly through some serious short-term financial turbulence because they're betting it will let them reach a much higher, much more profitable cruising altitude in the years to come. The big question is, will it be a smooth ride for everyone on board? JetBlue just dropped its latest earnings, and yeah, there were some big losses. But if you look just under the surface, there's actually this really clear strategy for a major turnaround. So today, we're going to break down how a story that looks like it's all about loss is actually a story about recovery. Okay, so let's just get right to it. The big headline number, a loss of $177 million. I know, that sounds pretty bad. So, how in the world is this a story about recovery? Well, that's what we're here to unpack.
All right, first things first, let's just rip the Band-Aid off and look at those tough numbers. These are the figures that grabbed all the headlines and probably gave a few folks on Wall Street a little bit of a stomachache.
So, the airline reported an adjusted loss of 49 cents per share. Now, adjusted just means they've taken out some one-time costs. The thing is, analysts were expecting a loss of 46 cents. So, coming in at 49 cents, yeah, that's a little bit worse than expected. It just kind of signals that the financial pressure was a bit heavier than everyone thought.
And all of that translates to that big number we saw earlier, a total net loss of $177 million for the quarter. I mean, that's a pretty significant figure, and it really just highlights what a tough environment they've been flying through.
Okay, so you see a loss that big, and your first thought is probably, wow, the revenue must have been in a total nosedive. But this is where the story gets, well, a lot more complicated and, honestly, way more interesting. To really get this, we have to talk about a super important airline metric called RASP. It sounds complicated, but it's not. Just think of it like this. For every single seat on a plane, how much cash is the airline bringing in for every single mile that seat flies? It's a fantastic way to measure how efficient an airline is, and it lets you compare apples to apples across the industry.
So check this out. JetBlue's total revenue, it dropped by 1.5%. But, and this is the critical part, they also cut the number of seats they were flying by almost the exact same amount, 1.6%. So, to put it simply, they flew less, so they made less money. This wasn't some collapse in demand, it was a deliberate, strategic move.
But here's the real kicker. That efficiency number we just talked about, RASP, everyone, including JetBlue, expected it to fall. Instead, it actually grew by 0.2%. Now, I know 0.2% sounds tiny, but it completely blew their own forecast out of the water. And why did that happen? Well, two big reasons. Really strong holiday demand, and, as we're about to see, a loyalty program that's an absolute powerhouse.
Okay, so if the revenue per seat was actually pretty decent, where in the world did that $177 million loss come from? Well, the answer isn't on the income side of the equation. It's on the other side, the cost side.
And that brings us to RASM's sibling, CASM, or cost per available seat mile. It's the exact opposite. It measures how much it costs the airline to fly one seat for 1 mile. This metric is all about keeping expenses in check.
And this little table right here, it basically tells the whole story. You can see operating revenue dipped just a little bit, right? But look at the operating expenses. They jumped up 3.7%. It's simple math, really. When your costs are climbing faster than your income, you've got a classic profitability problem on your hands.
And here's where it really hurts. If you take out the price of fuel, which can jump all over the place, JetBlue's core operational costs, we're talking about things like salaries, maintenance, that kind of stuff, they shot up by a whopping 6.7%. This is the real source of all that financial pressure.
But it wasn't all doom and gloom. Even with those costs acting as a major headwind, there was one part of the business that was shining really, really bright, and it's showing them a clear path forward. I mean, just look at this quote from the report. It's pretty incredible. Loyalty revenue grew by 8% for the year. Now just think about that for a second. The airline was flying less, which means they were selling fewer tickets overall, but the money coming in from their most dedicated, loyal customers, it was growing and growing strong.
And we're not talking about some small side project here. This loyalty program now makes up a full 13% of JetBlue's entire revenue. That's up from 11% just a couple of years back. It's become this incredibly important, high-margin, high-performing asset for the whole company.
So picture this. You've got this big cost problem on one hand, but on the other, you have this massive strength with your loyal customers. JetBlue's whole strategy is basically to fix the first problem while doubling down on the second. So let's take a look at their recovery plan. They call it the Jet Forward Transformation. And, this isn't just some fluffy corporate slogan. It's a real, concrete, multi-year program with super specific goals. Number 1, fix the operations so they're more reliable. 2, slash those structural costs. And 3, improve the quality of the revenue they're bringing in the door.
And guess what? It's already working. In its very first full year, this Jet Forward plan delivered over $300 million in real, tangible financial benefits right to the bottom line. I mean, that is a massive real-world impact.
The blueprint itself is actually pretty simple and laser-focused. First, improve reliability. Make sure the planes actually run on time. Second, go after those deep structural costs that were just spiraling out of control. And third, strengthen the revenue stream by really focusing on attracting and keeping those higher-paying customers.
All right, so with that plan officially in motion, what's the flight path look like for 2026? Where are they headed next?
Well, for 2026, the airline is signaling that they're getting back to growth, but in a smart, measured way. They're planning to fly more seats and, even more importantly, they're expecting their revenue efficiency. Yep, that key RASM metric we talked about, to grow even faster.
And this isn't just some pie-in-the-sky hope. They've got a plan for it. They expect that super powerful loyalty program to add about 1 full percentage point to that RASM growth all by itself. Then, new product enhancements will tack on another 3/4 of a point. And it's all backed by just being smarter about their network and their planning.
So what's the big takeaway here? Yeah, that headline loss was real, and I'm sure it was painful. But the underlying strategy for a comeback isn't just a plan on a piece of paper. It's already in motion, and it's already delivering results. The flight plan is filed, it's clear. But as we all know, in an industry as volatile as aviation, having a good plan is one thing. Nailing the execution? Well, that's everything.